My name is Ben Reppond. Today is September 25th, 2024. Last week, as you know, the Fed announced its 50 basis point rate cut. The markets responded positively. Where do we go from here? Is that going to stimulate the markets enough? I'm not going to cite any, but I have read several comments from economists or money managers stating that they're ahead of us in the next couple of months, let's say up to the election. I'll extend it and say even to the end of the year, because the election, the voting is on November 5th. Based on the last few times that we've had elections, it's usually not decided that night. Sometimes it's decided weeks later or even months later. So I don't know how that's going to play out. But regardless of what happens, I think there is going to be volatility. People are saying that. Right now, there is not. The markets right now are not that volatile. The volatility index is down, and the markets are generally up. And so, but I do think that they're right. I think there is going to be some volatility in the market. And I would say, just to you as an investor, if you manage your own money, for example, you have to think about, do I want to really be fully invested or not? And if not, then you've got to figure out, okay, when and what method do I use to get back in the market? Because it very often happens, the market will take off and leave you behind. I've seen it happen a lot. And geopolitical events like this, an election, will oftentimes be a head fake to people, and they will get out because they fear this or that, and then they don't have a method to get back in. And that is more costly. So if you do get out, have a method, think about it, and then apply your method at that time. Okay, now these are the dashboards. The first one is all of the indexes. So I've got 6 major indexes: the Dow, S&P, the NASDAQ 100, the Russell 2000 Small Cap Index, and 2 foreign ETFs for the developed markets, EFA, and the undeveloped markets, EEM. And then we look at the yellow box to the right of those titles, and then the pink box. The yellow is the last week, the pink is the year to date, and to the right of that are the moving averages going from left to right, the 20, 50, 100, and 200-day moving averages. Where are those indexes relative to their moving averages? The last item on the list, going down from top to bottom, the last item is TLT, which is the long-term treasury bond, and the 20-year. And it was negative for the week. Everything else was positive. And it is approximately break even, no change, year to date. When you take the S&P 500, you break it apart into its component parts, which are sectors. There are 11 major industry sectors within the economy and inside of the S&P 500. And they are, you can see them on the second column: financials, industrials, technology, consumer staples, healthcare, etc. And those are ranked in order based on their performance year to date, which is in the pink box. And so you can see the best performer is financials, 21% positive, industrials up 16, etc. All the way down to the bottom, and energy is up 5.87%. To the right of that, to the right of the pink box, you can see again the moving averages, and their red dots illustrate the if they are below that moving average. So again, left to right, 20, 50, 100, and 200-day moving averages. And you can see there's one of them, healthcare, which is below its 20-day moving average. The others are positive. On energy, it is below the 50, 100, and 200-day moving average. So energy is definitely weak on a year-to-date basis. And relative to other sectors, definitely weak. Okay, this is a line chart showing the S&P 500 for the last 24 months. So one move, one change in this line represents 1 week. So out of 24 months, that would be 104 moves, up or down. And from the beginning, in October of 2022 to present, it shows that it has generally gone without too much interruption in an upward direction. So I put a black arrow to show you the direction of the S&P 500, including at the very far right of that, you can see the move up and another move up. So that's last week and this week. So it's, again, moving in an upward direction in kind of an intermediate term basis and on a short term basis. This puts this also a 24-month chart. I wanted to show it to you on a candlestick chart. So if the week begins here and goes up to here by the end of the week, that is represented by a hollow candle. If it begins here and goes down, that's represented by a red candle. And there are a few of them that kind of end where they begin. But you can see the amount of red candlesticks moving down and the amount of hollow candlesticks moving up. There are definitely more, just visually it appears to me, more positive moves in the last 2 years using the S&P 500 as a proxy than the opposite. So you can see at the very right of the red one indicates that week it went down. The following 2 weeks are 2 candlesticks that are hollow. The one right next to it is almost equal to it, except it's positive. The one to the very far right didn't go up as much, but it went up, and that is also positive. So anyway, it's a good view of what's going on in the market. And again, this is the average, weighted average of 500 of the largest companies on the stock exchange. Okay, this is a line chart also comparing the NASDAQ 100, tech-heavy NASDAQ 100, to the S&P 500 broad market, 24-month chart. So if it goes up, this favors the NASDAQ 100 growth, and if it goes down, it favors value. Or I should say, it favors value and growth. So it's the S&P 500, which is a combination of value and growth. So this last week, fairly neutral as far as the NASDAQ 100 goes, but when you look at it from the beginning of 2023 to present, I put a black arrow to show that generally speaking, growth has outperformed value. Now, if we go and look at the last 3 months, I didn't put an arrow on this, but I'll just bring it to your attention. The last 3 months, you can see that the line going up and down has generally speaking come down, so which favors value. So it depends if you're looking at a short term or intermediate term. Okay, the next is growth and value. And this breaks apart clearly the stocks inside of the S&P 500 into growth stocks and value stocks. And again, it's generally gone up, favoring growth over 24 months, or I should say over 21 months since the beginning of 2023. It's definitely favored growth. But I put a black arrow here to show this short-term move in the last 3 months as being more oriented to value than to growth. Some up and some down, but more down, which favors value. Okay, the S&P 500 compared to small cap stocks. So this is not growth or value, this is just large companies versus small companies. When it goes up, that favors large. When it goes down, it favors value. Again, you can see intermediate term generally has gone up, favoring large companies. However, I didn't put an arrow here, but however, again, in the last 3 months, you can see it's gone down some, favoring small companies or small cap versus large cap. And small cap is, I use IWM as the ticker symbol for the ETF for small cap stocks. This is a 5-year chart looking at the ETF TLT going over 60 months. So I look at approximately the last year. This is from October of 2023 to present. So let's say it's 11 or 12 months. I put a black arrow showing that generally the long-term government bond in the last year has been on an upward trend. But if you look in a longer-term period, this 5-year period, you can see it has clearly gone down quite a bit, and is still way down. But I think those that are holding bonds or bond ETFs or bond funds would appreciate the fact that it started to go back up, which is helpful for the buy and hold investor. The dollar on a short-term basis, the last couple of months, continues to decline. We don't know if this is a longer-term trend. I'm not seeing that yet, but it's below its 20-period moving average. But it has come down in the last couple of months. Gold is probably the big winner. Gold just keeps on rocking and rolling. 24 months, look at it. I mean, that's a pretty impressive chart. And continues to make gains. Silver, same thing, but silver is a rougher ride. It's similar in a way, but you can see a lot of up and down and up and down. So gold, from a value standpoint, gold has been more consistent in its upward move. When it moves up, like it did this week for both silver and gold, silver looks like it has outperformed gold. Bitcoin, again, moving up and moving in an upward direction. Still below its 20-period moving average, but was positive for the week. The volatility index, again, I show you the very end of it with the black arrow. It has been coming down. It actually, on an intraday basis or a daily basis, went up as high as 65 during the recent move up. But it is all the way down to 16 right now. So volatility coming down in the short run. But as I said, I'm hearing people talk about, I don't know if they're right or not, but maybe they don't know if they're right, but they're talking about volatility coming in the coming months in the market. I put the marker at 24. You can see the how far the market is, the S&P 500 is away from the my mark at 24, using that as a approximate level where volatility starts to become more dangerous. Still quite a bit below that, but as you can see from the recent spikes on the far right of the chart, it doesn't take much to push it up into that area or through that 24 mark. Asbury 6 has 6 metrics. They have 5 of them that are positive, 1 is negative, and I think they had the same. There were different ones last week, but it was also 5 positive and 1 negative. So that's, from their angle, a positive indicator for the market. Relative cross-asset relative performance. This compares one asset to another. So I look at all 3 time periods of the last quarter, month, and week. Last week, month, and quarter. And stocks are stronger than bonds. Small cap, all 3 time periods, small cap is stronger than large cap, or the S&P 500. The U.S. is stronger than developed markets, and corporate bonds are stronger than government bonds. Countries, U.S. compared to other countries, this is always kind of a mixture here. So the ones that are stronger than the U.S. are Canada, Malaysia, Hong Kong, Singapore, India, Thailand, been a while since we've seen Thailand. And those where the U.S. is strongest are Chile, Brazil, Mexico, Switzerland, France, the UK, the Eurozone, South Korea, and the Pacific. So an interesting mixture. You definitely see some Asian countries here, a lot of Asian, plus Canada. This is, again, I used South Korea last time as I wanted to show a chart that had the most consistency for one country versus another, and I used South Korea as my example. And this shows, on a relative strength basis, the stock market, using the S&P 500 as our proxy, compared to the Korean stock market, and the ticker symbol we use for an ETF is EWY. On a relative strength basis, the S&P is that much stronger than the Korean market. And this was the chart that, to me, had the most consistency. Gold and silver both went up. The spot price both went up this past week. Gold went up 1.7%. Silver went 1.5% compared to the previous Friday. So Friday to Friday. The spot price is $26.22 for gold and $31.17 for silver. Now, you know, we've seen these much lower numbers in the low 2000s for gold, and you know, down in the 20s or even low 20s for silver. So in the past year, there's been a lot of move up on both of them. The gold-silver ratio is still 84-1 gold versus silver, which favors silver as a better buy. For a monster box of silver, 500 rounds of generic rounds of silver is $16,275 as of this past Friday, using the current price, which is $31.17 plus a markup of $138, is a retail price of $32.55. The spot price is still, in my opinion, based on over the past few years, still relatively low. That's not a high price. I mean, I've seen it down, you know, around $1, but not lately. But anyway, $32.55 per round, including the markup. And the source is my son, Preston, who is in that business. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.